Let's talk about the Roth IRA. Let me first kind of describe why the Roth IRA account is kind of a no-brainer for everyone. The two key points is a Roth IRA is a retirement account that lets you invest money where you have already paid taxes on. So it's after-tax contributions really that you're making into this type of account. The second point is your money once inside the Roth IRA grows tax-free. So if you make any kind of investments in there and it appreciates, basically you wouldn't, if you bought and sold said investment, you would not have to pay any taxes on that if it stays within the Roth IRA. Distributions, once they're qualified, would most likely come out tax-free in almost every circumstance. Now, let me kind of go through a scenario where, and this will kind of help describe why a Roth IRA could be so advantageous. So one of the biggest Roth IRA balances I've heard of is from Peter Thiel, the co-founder of PayPal and billionaire entrepreneur. So long ago, back in 1999, he made a small contribution of just $1,700 inside his Roth IRA. I think the limit back then was $2,000, which he then, because he was a founder of PayPal and an insider, he was able to buy 1.7 million shares of PayPal within his Roth IRA. Of course, regular retail investors like you and me probably would never have that opportunity. But nonetheless, in 2002, when eBay acquired PayPal, the balance ballooned to over $28 million. So it went from it went from $1,700 to $28 million. He since has used those funds in his Roth, so he's most likely liquidated that investment within the Roth, and then used those funds to fund private companies such as a lot of like Facebook and so forth. And from what I understand now, that Roth IRA account he has is worth $5 billion. Imagine that. And the best part of that is it's all tax-free. So once you start your clock, it's a 5-year clock, and you're over 59 and a half, those distributions, even on those gains, those earnings, come out tax-free for you. So imagine the billions this guy has saved by putting this in a Roth versus, say, if he had it in a regular brokerage account. Of course, no one is probably going to have the level of success that Mr. Thiel has had on this Roth, but it's an example of why it's so important in my opinion, to open a Roth IRA now. Let me kind of go through the basics of a Roth. The Roth IRA does have limits since it's such a great account. The IRS has contribution limits of $7,500 for 2026 if you're under 50 for a year. If you're 50 or older, you get an extra. You get a catch-up contribution, and the limit is $8,600 for the 2026 year. As I said before, one of the reasons why it's such a great account and why you want to open it immediately is it starts your 5-year clock. So for example, if you made a contribution now on June 19, 2026, it actually starts your 5-year clock. If it was your first one, it would start your clock at January 1st, 2026. So let's say, for example, you're 55 years old, you open that Roth, you start your clock at January 1st, 2026. 5 years later, when you're 60, let's say, you made contributions throughout that time and the account's now worth, let's say you've made a total of 30,000 contributions and the account's now worth $60,000. That all comes out to you tax-free. That's so, and you'll see it. They'll, if you when you take it out, your custodian, the brokerage firm, they'll send the IRS and yourself what's called a 1099-R, and it'll show a code Q standing for qualified distribution. So certainly take advantage of this, and you don't have to, if let's say you're low one funds. It doesn't have to be the full 7,500. You could put in $50 just to start your clock. So if you put in $50 now, June 19th, 2026, it'd start your clock to January 1st, 2026. So that is very, very advantageous. I think one other key point here is let me go through another scenario. Let's say you contribute $7,500 a year ago, back in say 2025, January 1st, or let's say even 2 years ago, 2024, and you've made no other future contributions. Let's say you put in the full 7,500 and the account's now worth 10,000. Then let's say fast forward to now. Unfortunately, you're experiencing a medical emergency. You're low on funds and you need $5,000. The IRS allows you to take that $5,000 out of your Roth without penalty, since it's less than your original contribution of $7,500. So contributions per the IRS are always going to be tax-free coming out. Though, since everyone's individual situation could be different, certainly would consult with a tax professional on your own personal situation. But if you look through irs.gov, and you'll see what I just said. Now, the Roth can also be funded by what's called a Roth conversions, which I'll make a separate video on, since that topic could be rather large, and it's. I think it's also a tool that certainly will help you down the road in your retirement. Now, to fund the account by contributions, the IRS does have certain requirements. So, depending how you file your taxes, let's say if you're filing jointly, you or your spouse must have earned income to contribute. However, you cannot contribute more than you make. So if your earned income is, $2,000, you wouldn't want to contribute more than that. Also, with the Roth IRA, it's not versus a traditional IRA. It's you would not be able to deduct that from your taxes. Now, your Roth IRA eligibility and contribution limits are based on your MAGI, Modified Adjusted Gross Income. Depending on tax filing status, now filing single and your Modified Adjusted Gross Income is under $153,000, you can contribute the full amount. Married filing jointly, it's $242,000. You can do the full amount. Now, this is if it's $242,000 or less. Now, this is for 2026. Now, if you're greater, you can take a look at IRS Publication 590, page 39 is where it starts on how you calculate the reduced contribution amounts. So if you're, let's say, at filing individually, and your income is, say, your MAGI is, say, $160K, you could still make a contribution. It's going to be a lesser amount. You can calculate it by looking at what the IRS has and how you calculate that. Though I will say some sites like Fidelity or Schwab do have in-house calculators on their website to help you, guide you on how to see how much you can contribute. Now, I will state there are some loopholes if your modified adjusted gross income is too high to make a direct contribution to a Roth. It's typically what's termed a backdoor Roth, and this involves making a non-deductible contribution to your traditional IRA and then immediately converting it to your Roth IRA. Now, this can be a bit more complex, and I would strongly recommend you do your due diligence on this. There's some great articles. If you just Google it, and for the Wall Street Journal, I'll say has some good resources on this, or maybe even speak to your tax advisor on this. Since unfortunately, I've seen many past clients make mistakes on this, and if you have a prior balance in the traditional and so forth, you can't segregate it. It's on a pro rata basis, and you may end up owing taxes on it. So certainly look into this before you go ahead, and if you're at a high income and you want to try to do the backdoor Roth, certainly do your full due diligence before actually doing it, and maybe even consult with your tax professional. So any questions you have on this, go ahead and throw them in the comments. Other than that, have a great day.